When war breaks out, governments print trillions. Inflation just, well, it skyrockets, and the cash in your pocket loses its value by the hour.
Right. It's basically melting.
Exactly. So, why, historically, does every sane person immediately rush to the bank to hoard as much of that rapidly dying cash as possible?
It's a massive paradox, honestly.
It really is. Welcome to the Deep Dive. Today, we're answering that exact paradox. Because, when we picture the economic toll of a conflict, we usually envision the physical devastation.
The visible stuff. Destroyed bridges, cratered roads.
Yeah, rubble. But beneath all that visible destruction, there's this invisible architecture collapsing. And that's the architecture of trust, of credit, and of liquidity that keeps a modern economy actually functioning.
And when that invisible bridge collapses, the financial organism doesn't just slow down, it seizes up completely. I mean, it is a total systemic paralysis.
Which is exactly our mission for this deep dive. We're exploring the hidden, deeply consequential financial mechanics of armed conflict. And we're pulling from some incredibly detailed source material today.
Yeah, we've got extensive excerpts from a piece called War Economy Chapter 15, Liquidity, Crises, and Cash Hoarding.
Right. And we're going to break down why physical cash becomes the ultimate king when the world falls apart. And more importantly, how you listening right now can apply these historical lessons to build your own personal financial bunker.
It is a critical subject, especially when you look at how fragile our globally interconnected markets are today. We're really going to trace how massive macroeconomic shocks functionally trickle down to the actual money sitting in your checking account.
Okay, let's unpack this, because we need to start by diagnosing the foundational problem. What is physically happening to an economy the exact moment a conflict breaks out?
Well, the text makes a really sharp distinction right away between two concepts that people, even seasoned investors often mix up.
Solvency and liquidity.
Exactly. It's the most important distinction in finance during a crisis. So solvency means you have enough total assets to cover your liabilities.
Like your net worth is positive.
Right. If you add up everything you own and subtract everything you owe, you're solvent. Liquidity, on the other hand, means you can access those assets right now to pay for something immediately.
Which is very different.
Completely different. During a wartime crisis, the initial problem isn't that everyone suddenly goes broke or becomes insolvent. The problem is that creditworthy borrowers suddenly cannot get loans.
Solvent banks can't fund their daily operations.
Exactly. And perfectly viable businesses can't pay their suppliers because the cash simply stops moving.
Okay, let's ground this. Imagine you own a $10 million mansion outright. You have no mortgage, so you are incredibly solvent.
Very solvent, yeah.
But you have $0 in your checking account. If you need to buy a loaf of bread today, you are completely illiquid. You can't, slice off a chunk of your driveway and hand it to the baker.
That is the perfect way to visualize it. You just can't transact. Now, take that driveway scenario and multiply it by millions of citizens and corporations simultaneously.
The scale is terrifying.
It is. The Center for Economic Policy Research, or CEPR, has documented this striking phenomenon they call the flight to liquidity.
Right, the flight to liquidity.
Yeah, because of the extreme existential uncertainty of war, households and investors just panic. They stop lending, they stop investing, and they start hoarding cash and near-cash instruments.
Which makes total sense if you're a terrified individual trying to protect your family. You want the cash under your mattress because you genuinely don't know if the banks will open tomorrow.
If we connect this to the bigger picture, individual rational behavior creates a collectively irrational disaster.
How so?
While by rationally hoarding cash to protect your own family, you are participating in a massive simultaneous withdrawal of vital liquidity from the banking system, precisely when the national economy needs that liquidity the most to survive the shock.
Wow. And it isn't just everyday citizens hoarding cash and freezing the system, is it? The government is panicking right alongside them.
No, absolutely. The CPR research points out that governments dramatically pivot to short-term borrowing during these acute crises.
I remember seeing that. The data shows the share of long-term government debt actually falls by about 2.2 percentage points.
Yeah, which equates to roughly 1.2% of GDP.
But walk me through the mechanics there. Why does a drop in long-term debt actually matter?
It matters because it drastically increases something called rollover risk.
Rollover risk, okay.
Right. When a government needs billions of dollars immediately to fund a military response, and the global markets are just too chaotic to confidently lock in 20-year bonds, the government floods the market with short-term debt.
Like 30-day or 90-day treasury bills.
Exactly. They get the cash fast, but the catch is that this debt expires almost immediately.
So rollover risk means they are essentially funding a multi-year war using a 30-day adjustable rate mortgage.
That's a great analogy.
They have to constantly pay off and reborrow that exact same money every single month.
Precisely. And if the market conditions worsen between those 30-day cycles, which, they invariably do when a war escalates, the interest rate required to refinance that short-term debt skyrockets.
So their borrowing costs just explode.
The government's cost of borrowing spirals totally out of control, making an already fragile wartime economy exponentially more vulnerable to collapse.
Okay, here's where it gets really interesting. We know that war inevitably causes massive inflation. The data confirms this, right?
Oh, without a doubt.
The CEPR research shows that in the decade following the start of a conflict, consumer prices jump about 62%.
Yeah, a massive spike.
So my question is, why on earth are people rushing to hoard physical cash if its purchasing power is literally melting in their hands by the hour?
It is the great paradox of wartime finance. Why hold an asset that is statistically guaranteed to depreciate?
Exactly. It makes no sense.
Well, the CEPR data presents a really fascinating statistical reality. While the nominal money supply rises by 67% in that decade, real money balances remain totally unchanged.
Wait, slow down. Nominal versus real balances. If the government is printing 67% more cash and flooding the streets with it, how can the real balance not change? Walk me through the math there.
It comes down to purchasing power. So nominal is the face value of the bills. Real is what those bills can actually buy in the real world.
Okay.
If you have $100 and the government prints so much money that prices double across the board, your nominal balance is still $100.
You still physically hold a $100 bill.
Right. But your real balance, your actual purchasing power has been cut in half. To understand why people willingly accept this guaranteed loss, we have to look at research from Sweden's central bank, the Riksbank.
Okay, what do they say?
They describe a macroeconomic loop called a fiscal dominance regime.
A fiscal dominance regime. Break down the mechanics of that loop for me.
It starts with the government needing massive, immediate funds for the military. Raising taxes to fund a war is politically toxic, and it's slow.
You don't have time to pass a tax bill when tanks are crossing the border.
Exactly. So the government essentially forces the central bank to print money to finance the national deficit. This newly printed money floods into the system, chasing a very limited supply of goods.
Which causes inflation to spike.
Right. That inflation rapidly erodes real wages and savings. So just to afford the exact same basic necessities, food, fuel, shelter, citizens demand more physical cash.
Because everything costs more.
Exactly. Then the government prints more to meet that demand, and the cycle accelerates into a vicious loop.
So people aren't hoarding cash because they're confused about inflation. They know it's losing value.
Absolutely.
They're hoarding it because every other financial instrument, stocks, corporate bonds, derivatives, has become fundamentally unreliable.
Yes. When the entire financial architecture is burning down, the certainty of a 10% loss to inflation is vastly preferable to the uncertainty of a 100% loss if your bank collapses or the stock exchange goes to zero. That is the exact psychological calculus. And this dynamic acts as what researchers call a silent tax.
I have to say, silent tax is a brilliant phrase, even if the reality of it is completely grim. How does a tax work without a tax collector?
It works by dilution. No politician has to stand in front of a microphone and pass a law to collect it. By inflating the currency to pay for the war, the government is effectively siphoning real wealth and purchasing power away from the citizens.
And transferring it directly to the state.
Right. It extracts wealth from everyone holding cash or fixed income assets simultaneously without a single IRS agent ever knocking on your door.
All right, so we've established the psychological drive. Millions of individuals rationally hoarding depreciating cash just to survive. Let's look at the structural side.
The plumbing?
Yeah, what happens to the actual plumbing of the financial world when everyone demands their money at the exact same moment?
You get a systemic heart attack. And the most acute, visible symptom of that heart attack is the bank run.
The bank run. The source material highlights this terrifying reflexive dynamic behind bank runs. You don't run to the bank because you've carefully audited their quarterly balance sheet and determined they're insolvent.
Nobody does that.
Right. You run to the bank because you look out your window and see your neighbor running to the bank. You panic strictly because you think others might panic.
And you absolutely refuse to be the last person in line when the vault runs dry?
It is the ultimate self-fulfilling prophecy. Fear creates the exact insolvency it is afraid of.
It really does. The historical case study the text provides for this is the outbreak of World War I in August 1914. It remains one of the most severe, catastrophic liquidity seizures in modern financial history.
The scale of the panic in 1914 was unbelievable. But how did it actually play out practically?
Well, at the time, the classical gold standard was the absolute bedrock of global finance. Paper money was literally a promise for physical gold.
You could just swap it out.
Right. But as war became imminent, foreign creditors and domestic citizens alike realized paper promises might soon be worthless.
Hmm.
So they suddenly demanded their claims be settled in physical gold.
They wanted the hard asset.
Exactly. The gold began draining out of the British banking system at an astonishing rate. Within just days of the conflict starting, the Bank of England was bleeding so much gold, they were forced to suspend convertibility entirely.
And the detail from the text that absolutely blew my mind was about the stock markets.
Oh, yeah.
The London Stock Exchange closed on July 31st, 1914. And they didn't close for a long weekend to let things cool off. It was the first time they had closed in their 113-year history, and they stayed closed for 5 straight months.
And the New York Stock Exchange followed suit, closing the very same day and not fully reopening until mid-December.
I want you to really put yourself in that position. Imagine logging into your brokerage account tomorrow, seeing that the stock market is closed, and realizing you simply cannot touch your retirement savings or sell your shares to pay your mortgage for half a year.
It's terrifying. 5 months of zero liquidity in the world's biggest markets. This raises an important question. How do governments prevent this level of systemic panic from destroying the nation from the inside before the war even truly begins on the battlefield?
Right, because if the economy dies, the war is lost anyway.
Exactly. World War I proved that standing back and letting the panic naturally run its course was national suicide. This trauma is exactly why we eventually saw the creation of deposit guarantees.
Like the FDIC in the United States.
Right. And the expansion of the central bank's role as the lender of last resort, standing by to flood banks with emergency cash to stop that reflexive panic dead in its tracks.
Which brings up a fascinating pivot in how economic warfare evolved over the last century. Because the financial response in 1914 was so chaotic, governments were forced to learn.
They had to adapt.
Fast forward just 2 decades to World War II, and the funding strategy completely shifted. According to the Wikipedia data cited in our sources, during WWI, the U.S. government spent over $300 million, which is over $4 billion in today's money, just on advertising campaigns for war bonds.
That massive advertising investment was crucial because it laid the psychological groundwork for the highly sophisticated, celebrity-driven war bond drives of World War II.
Sure.
And those WWII bonds were a masterclass in macroeconomic management. Yes, they provided immediate cash to fund the military, but they served a vital, hidden secondary purpose.
They acted as an inflation pressure valve.
Exactly. The government was spending massive amounts of money on wartime production, which meant factories were booming and workers had pockets full of cash.
But there was nothing to buy.
Precisely, because factories were building tanks instead of consumer goods. Lots of money chasing no goods equals hyperinflation.
So they needed a way to soak up all that extra cash.
Right. By convincing citizens to voluntarily lock up their excess cash in war bonds, the government absorbed that dangerous money supply out of the economy.
And internationally, WWII forced an even bigger structural pivot. Britain's financial reserves were nearly decimated, paying for the early years of the war, which necessitated the U.S. Lend-Lease program just to keep them afloat.
Yeah, they were running on fumes.
Ultimately, right as the war was ending in 1944, the major powers realized they couldn't survive another era of financial anarchy. They signed the Bretton Woods.
They realized that relying on the ad hoc survival tactics of 1914 was no longer an option. Institutionalized global liquidity was now a strategic necessity.
But let me push back on this timeline a bit. Thinking about more recent history, we don't really see celebrity war bond drives anymore. Captain America isn't going door-to-door selling bonds to fund modern conflicts.
That is very true.
So looking impartially at the data, and again, strictly the economics, not the politics, how did the U.S. fund the wars in Iraq and Afghanistan?
It is a stark contrast to the mid-century model. The Institute for Economics and Peace, the IEP, provides a really thorough analysis of this shift.
What did they find?
Instead of funding those conflicts through broad public bonds or increased taxation, the U.S. relied almost entirely on deficit spending. They funded the wars through borrowing while simultaneously implementing sweeping tax cuts.
Okay, just to be clear, we are purely looking at the economic mechanics here. Walk me through the structural impact of funding 2 decades of conflict entirely through deficit spending. How does that practically affect the economy?
The IEP research outlines a very clear chain of causality. Think of fiscal space as a government's emergency credit limit. By using deficit spending for the wars, the U.S. essentially maxed out those national credit cards.
So the fiscal space was gone.
Right. So when a completely unrelated crisis hit the global financial crisis in 2008, the government's ability to respond with massive fiscal policy, like direct spending programs, was severely constrained by that existing war debt.
So because the fiscal side was tapped out, the monetary side had to step in.
Precisely. It forced the Federal Reserve to do all the heavy lifting. They dropped interest rates to historic lows and flooded the banking system with cheap liquidity to keep the economy breathing.
But that had its own consequences.
Big ones. That flood of cheap money inadvertently supercharged the housing bubble, leading to the subprime mortgage crash. The macro choices of wartime finance cascaded directly into a peacetime financial catastrophe.
The ultimate unintended domino effect. And if we want to look at a completely modern, real-time example of liquidity freezing overnight, the sources point to the 2022 Russia-Ukraine conflict.
Yeah, an incredibly stark example.
Again, strictly looking at the economic data here, the immediate financial shockwaves were staggering. Within days, the ruble dropped 50%. Russian central bank reserves were frozen by coordinated international action, and major Russian banks were excluded from SWIFT.
And we should clarify SWIFT because it's deeply misunderstood. SWIFT isn't a bank vault. It is the secure messaging system that global banks use to authorize payments to each other.
It's like the WhatsApp for international finance.
Exactly. When you are excluded from SWIFT, your money isn't necessarily seized, but it is functionally paralyzed. You cannot clear international transactions.
The plumbing is completely blocked. And the secondary effects of blocking those pipes rippled globally in hours. The text highlights how European energy traders suddenly faced massive margin calls because natural gas prices skyrocketed overnight.
Let's explain margin calls simply because they are the grim reaper of liquidity crises.
Please do.
Imagine you are a trader who buys $1 million worth of energy contracts, but you only put down $100,000 of your own cash. You borrowed the rest from a broker.
Okay, so you're highly leveraged.
Very. When the market violently swings against you, the broker demands more cash immediately to cover the risk. If you don't have it, they force sell your assets.
And because the energy traders didn't have the cash on hand to cover those massive required deposits, the chaos spilled over into commodities.
Everywhere.
The prime example from the text is the London Metal Exchange. Nickel prices went completely haywire, skyrocketing 250% in a single day.
Which is unprecedented.
It got so extreme, the exchange literally forced canceled trades and completely suspended nickel trading. The infrastructure just couldn't handle the stress of everyone scrambling for cash at once.
It perfectly illustrates how highly leveraged and fragile modern financial infrastructure is when a geopolitical shock hits. A war on one side of the continent forces a metals exchange on the other side of the continent to shut off the trading monitors.
So what does this all mean for you? After exploring a century of global macroeconomic chaos, we need to bring this right into your living room.
Right, the practical application.
Whether you are running a small business, managing a family budget, or trying to protect your retirement savings, how do you prep for this kind of historical reality?
The research from Store on securing liquidity during crises is very clear, and it brings us right back to our original paradox. Cash genuinely is king.
For businesses, what does that look like?
For businesses, this means maintaining excessively thick cash reserves well before the headlines get scary. You must reduce your reliance on rolling short-term bank debt because, as we've established, credit facilities vanish the exact second you actually need them.
And diversifying supply chains, right? If your only supplier is in a conflict zone and trade freezes or SWIFT gets cut off, your business stops existing.
Absolutely.
The sources also mention hedging foreign currency exposure with forward contracts. Basically, locking in an exchange rate ahead of time to protect your business against those wild 50% currency swings we saw with the ruble.
Exactly. You want certainty when everything else is uncertain. Now, for individual investors, the text offers a very specific, aggressive golden rule during periods of acute geopolitical stress.
Which is?
Hold 20 to 30% of your portfolio in cash or near cash instruments.
20 to 30%. That is a massive chunk of a portfolio to leave sitting uninvested.
It is massive. And in peacetime, it would be a drag on your returns. But during a crisis, it provides ultimate optionality. It ensures you can meet your daily living expenses without being forced to sell your stocks or property at deeply depressed, panic-driven prices.
That makes a lot of sense.
Furthermore, the sources are adamant on one absolute rule: avoid leverage at all costs during these periods.
Because of the margin calls we just talked about.
Exactly.
If you buy stocks on margin with borrowed money and the market drops 30% in a week because a conflict breaks out, your broker holds a gun to your head demanding cash today.
And if you don't have that 30% cash buffer,
Yeah.
they sell your assets at the absolute bottom.
You get wiped out permanently.
Leverage turns a temporary broad market disruption into an unrecoverable personal catastrophe. The key survival tactic is diversification outside the banking system. The sources recommend international government bonds from neutral countries and physical gold.
Gold always comes up.
It does. Historically, gold acts as the ultimate store of value because it carries no counterparty credit risk. Its value doesn't rely on a bank or a government keeping their promise to pay you.
And honestly, I think the most important preparation mentioned in the text isn't even financial, it's psychological.
That's a great point.
When the crisis hits, the noise and the fear are going to be deafening. If you already have your 30% cash buffer and zero leverage, you don't have to participate in the bank run. You can stay calm, follow your plan, and actually look for long-term value mispricing.
Buying great assets for pennies.
Exactly, while everyone else is trampling each other running for the exits.
Psychological resilience funded by liquidity is the ultimate asset.
So to wrap up our deep dive today, the historical data proves that wartime liquidity crises leave structural, decade-long economic scars. We see that clearly with the persistent 62% inflation bump that follows a conflict.
The silent tax.
Right. But the enduring lesson here is that physical cash, as an unconditional, widely accepted store of purchasing power, remains the ultimate safety net when the institutional trust around us evaporates.
What's fascinating here is we've spent this entire time analyzing the mechanics of physical cash, physical bank runs, and traditional accounts. But I want you to think about this as you go about your day.
Okay.
As we move rapidly toward fully cashless societies and central bank digital currencies, what happens to the flight to cash in the next major geopolitical crisis? When a targeted cyber attack on a power grid might mean there is literally no physical paper left to hoard under your mattress, how does a population find safety?
Wow. That is a chilling and incredibly important thought to leave on. When that invisible architecture of trust and credit breaks, you want to make sure you have a backup plan that doesn't rely on the digital grid. Thank you so much for joining us on this deep dive. Stay curious, stay well informed, and we'll see you next time.